Hello, and welcome to the market update for Tuesday, February the 9th. The trading today, after we get through the market update, is going to be, we're going to continue with the Elliott wave analysis training, and we're going to talk about the wave characteristics. This is probably one of the ways that I use Elliott wave the most, because it deals with the psychology of these wave movements, and you can start to recognize when individual stocks or even the overall market is entering into these different waves based on these characteristics. So we'll talk about those characteristics and get into the details of those after we do the market update. As far as the direction alerts are concerned, we're starting to see the market get into a little bit of an overbought condition now that we've broken out to new all-time highs. You can see the momentum indicator is moved into the extreme range. Now, one thing I'll often talk about is that, once you get into that extreme range, it can stay in that range for a little bit. It can become even more extreme. Usually when you really get concerned is when it starts to get to the far right side of the box. That means you're really getting into an extreme condition, and usually you're very close to getting a market pullback when that happens. Although a market pullback can really happen anytime you enter that extreme range. So anytime you get in there, you start to pay attention for reversal signals. Bearish reversal candlestick formations or things like that are things I'll start looking for. And so the momentum is entered that extreme range. Hold on here. The breadth indicator is not in the extreme range yet. It's in the high area there, so it has a little bit of room where it could move. And you'll see this on all the indicators. We're entering into some of those extreme ranges, but we're not quite, where we have to be really, really concerned. Sentiment is in the high area there, but again, not in that extreme range there. We look at the buy-sell ratios. They've kind of widened out a little bit. They are getting into that little bit of that extreme range, and so we do have to kind of be aware of that. Now, we have gotten more extreme, but most of the more extreme ranges were when we dealt with that big market sell-off back in the spring, and those are historic ranges there. And so this is pretty wide. We're getting pretty wide here on the buy-sell ratios. What this means, there's far more stocks that are in the buy range than sells. Usually when you see that happen, you're getting close to getting a market pullback, because there's only so much. You need to have a lot of buying power to be able to push things higher. And at some point you start, pretty much everyone that wants to own stocks or owning the stocks, and it takes a lot more buying power to keep the prices at those levels. Remember, if nobody's buying, the prices just don't stay there. They start to come down to attract to a point where they attract new buyers or more buyers to come in. So when we see that extreme range there, that does concern us a little bit. And I would say that we're getting pretty close. I wouldn't be surprised if we start seeing some bearish reversal signals in the market sometime this week, maybe a little bit later this week. I still think we could run for another day or two, but we're starting to see a little bit of weakness today. Even we had a little bit of a mixed market early on, and still do, with the S&P being down slightly. We're starting to see a little bit of that weakness starting to show up. The sentiment indicator is, again, almost in that extreme range here, a little bit below it. But as you can see with all these, we're getting real close. We do have to start looking out for some of those reversals. We may have some by Thursday's update. We might see some of that starting to take place. All right, let's look at the individual charts here. One thing you've heard me talk about over the last couple of updates is I've been concerned with the light volume. You can see that pretty much for the last week we've been rallying, but we've rallied on lower volume almost every day. So that's usually a warning sign. You want to see expanding volume, but particularly as we broke out. One of the things I talked about last week when we were anticipating a breakout in the S&P was that I said we were getting that lighter volume. We're rallying on lighter volume. And back in here before we broke out, well, I was really concerned right into here because usually when you rally with lower volume, it's kind of that just a counter trend rally. We were worried about this being the start of a bigger sell-off, and we were rallying on lighter volume. Usually that doesn't last and it rolls over and you get another bigger move down. But that didn't happen. We managed to break out. The next thing I thought is, okay, well, maybe that volume will start showing up when we break out, and it just hasn't yet. And it shows by the way we've moved. I mean, we had the breakout move on Friday. Well, actually, we slightly broke out on Thursday, and then we had to move higher on Friday, but it closed lower than where it opened. So we gapped up, closed lower than we opened. That was kind of a bearish candle. We managed to go higher yesterday, but then today we're just kind of we haven't been able to really push higher here. So we're starting to show some of that weakness in the rally. Now, again, that can be temporary, and that's why you don't want to just assume that things are going to turn around and drop right here. But the fact that we're entering that overbought condition, and we're starting to see a little bit of this weakness, I think we're probably getting pretty close to seeing a little bit of a market pullback. Now, we haven't had big pullbacks, and so even if we do pull back, I'd expect it to be a lot like we saw a couple weeks ago, where it was just pretty quick. I mean, that could change, but at this point, I still think the market has a little bit further to run, particularly since there's so much money that's being poured into, with the Fed pouring so much money into the economy. At some point, the market will correct. It will get a bigger correction from that. It always happens. We saw this happen. The 2000 bubble, internet bubble, was fueled by all the money the Fed poured into the market with the worries about the Y2K, and when that, and before, even as that money was still being poured into the market ended up correcting, because the market's always forward-looking. So we do have to be careful just to assume that the Fed's still pouring money in the market, that the market rally is going to keep going for a long period of time. At some point, the traders will anticipate that it'll start to have a negative effect, and they'll have to, and the market will anticipate that and correct. I don't know when that is, but I still think we're probably a few months off from that taking place, particularly since the stimulus checks that are going to be sent out haven't even been sent out yet. So there'll be definitely a boost from that as well when that ends up taking place. But again, until then, you'll still have pullbacks, but they'll probably be more of these shallow pullbacks, which are great. They provide good buying opportunities. But it does look like we're starting to get kind of close to that. And now that we've broken out, really it could happen at any time. I didn't anticipate. I figured that when we got this far up, this close to breaking out, we're likely to end up breaking out. And so that's why I was pretty confident that last week in saying that the market should continue to move higher, at least in the near term. But now that we've broken out and you're starting to get these overbought conditions, you have to be a little bit concerned about that. We'll see how things go this week. Like I said, probably on Thursday we'll have a little bit better idea. The Dow and the rest of the indexes are pretty much the same. They've all broken out. Excuse me. The IWM, though, the Russell 2000, here's the NASDAQ 100 here. They're getting real close to moving into the extreme range. I think the S&P was. Let me go back to the SPY chart here. Yeah, the SPY is in the extreme range. The Dow isn't yet. Now, a lot of times what will happen, and this is why I say that we're getting these signals and we could be close, is that usually when you reach that really extreme range, you're going to have 3 out of the 4 indexes in that extreme range, or all 4 in the extreme range. You don't have to have all of them, but usually you kind of have that. They all kind of get in there when they're about to correct. The QQQ is, like I said, is close. NASDAQ 100, the IWM is really getting to the far right side of that extreme range. So with the NASDAQ 100 very close, the Dow a little bit a ways, but it could get there pretty quick too. And we saw the Dow, I think it was actually yesterday, the IWM, the Russell 2000 really outperformed. It was about a 2.5% move yesterday compared to about a 0.5% move for the other indexes. But the Dow was starting to outperform a little bit too, so it could catch up pretty quick if it had a big update. But again, that's something that we're just to keep an eye on. Let me take the volume bars off here so we can look at the chart of bonds here. Bonds are continuing to move lower. We had this bounce back in January that didn't hold. It's gone lower here. It looks like we could be getting another bounce as well. But overall, that trend is still continuing, and so we're assuming that's where the trend is. We're assuming that that's going to keep going that direction until we see some signs of a trend reversal, which we just haven't seen yet. So, and then moving on to gold. Gold has had a little bit of a bounce the last couple of days, but overall, we're still in that downtrend. Here's the previous lower high right here, and obviously we've gone to a lower low. So this is going to be a key area right here to look for. If gold can move above that, that's a first sign that the trend could be reversing. You get that higher high. But with the overall look being a lot more sideways right here, really it would need to break out of this area up here, because you've got this kind of sideways range. For me to really get bullish on gold, I'd probably want to see it break out above this area up here. It almost did back here. This is when we were starting to turn a little bit more bullish on gold. Quickly dropped right after that. But it's bouncing right now. But I'd still say that I'd still remain a little bit more bearish on gold. That could change, and I know some people are wondering why gold is underperforming with the anticipation that inflation is going to hit with all this money being poured in the economy. And it will, and we have seen some inflation. Food prices definitely have started to go up a little bit, but the market just hasn't reacted to it yet. At some point it will, and we'll probably see gold really start to take off. Another thing to keep in mind too is that the gold, the move into gold based on anticipation of inflation, there's Bitcoin is becoming a competitor on that trade, where people are diversifying a little bit into Bitcoin. Kind of the same way they would go to gold when with the expectation of inflation. And if you have been following Bitcoin's been on a tear. So I think the thought process is that a lot of that money is going into Bitcoin because they're getting a better return out of Bitcoin with it taken off the way it has, not as much in gold. Now that could change, and I think that's what will probably happen is you'll start to see when inflation starts to kick in, you're likely to see some of that money maybe come out of Bitcoin, maybe go into gold, and especially with the people that don't trust Bitcoin, that money will definitely flow into gold at that point, and so gold should have a rally at some point. But like I said, from a chart standpoint, I'm just not seeing it yet. And although you can anticipate reasons why it should go up, me personally, I try to avoid making huge predictions without seeing the evidence on the chart. Usually the chart is going to give you the best signal of when that rally is going to take place or not take place. And it can save you a lot of money if you have the patience to kind of wait for the chart to show you to get in, as opposed to just assuming that certain things are going to happen. All right, the dollar. I don't know, oil. Oil's next. Oil's been, again, continue to move higher. It is starting to get into that extreme range. Now, there have been a lot of questions as to, a lot of people have not understood this rally a little bit with kind of the oversupply of oil in the world and the likelihood that other countries are going to ramp up production. But I think the rally in oil has a lot to do with the new administration. Really, what's happened is the new administration came in, and from day one, they've tried to cut oil production here in the United States with some of those executive orders, and so it's lowering supply that way of oil in the world. And so I think that has a little bit to do with the rally as well, the anticipation that the U.S. is going to move more towards alternative energy, and obviously the anticipation of that is remember, traders trade off of anticipation, and I think that could explain a little bit of the rally there. But we are starting to get into that extreme range, and we're starting to get on the far right side of that extreme range, and so we'll have to see if we get a little bit of a pullback, although you don't have to get a pullback when you get in that extreme range. You can just get a consolidation where it moves sideways for a few weeks or so, which happened back here and happened over here as well. So, and I think that's important to realize on all these charts. Even with the markets right now, it could be that we don't get a pullback in the market, but we just move sideways for a week or two, and that kind of relieves a little bit of that overbought condition. So we'll keep an eye on that, see if that is how things kind of play out as well. The dollar, now the dollar had been rallying. It's now starting to move lower again, and the trend is still down in the dollar. And what this looks like right here, we did go to a higher high right here and had a higher low right here. But now in hindsight a little bit, it looks like that was a bearish ABC pattern, which happens in a correction, and that the dollar is probably heading to another lower low right there. So that looks like your wave A, wave B, wave C of that correction, and things are heading lower there. So the trend still is down, and it still looks like the dollar is moving lower, and that explains why commodities could rally as well. Usually there's that inverse relationship with the dollar and commodities, not always, but usually. And then finally, the VIX. VIX came way down from that spike from a couple weeks ago. And remember, that spike was really caused by the Reddit traders, GameStop. I think by now everyone's aware of that. It's made national news all over the place, and it's also made everyone a stock market expert, so to speak, that even if they've had no experience trading before. But there was anticipation, or there was a worry there that could be a systematic risk, where we saw with the Robinhood app, they were having trouble with liquidity because of all their margin concerns with with all these traders coming in and all the wild movement of those few stocks. They had to make those shut down some of the trading to try to prevent basically the company going under with some of the requirements they had to meet, capital requirements and things like that. And there was worry that could expand to other banks and other brokerage houses and things like that. And so that really freaked the market out, and that's why we saw the spike up in the VIX. As that kind of calmed down, and GameStop kind of came back down to earth again, that that worry also came back down. But we're now at a support area on the VIX there. So one of the signals that we can start to see that maybe the rally is getting close to being done is if we start to see days where the market is up and the VIX is up. That would tell us that those professional traders are still want to buy into the market, but as they're buying into the market, they're also buying those protected puts because they may not trust the rally going much further. And that's what can cause the VIX to move up along with the market moving up. And that's usually a warning sign that you're getting real close to a correction. Haven't seen that. Well, we saw it a little bit yesterday where the market ended up for the day and the VIX actually ended a little bit higher, but the VIX also ended up closing lower than where it opened. So although it was still higher than the day before, slightly higher than the day before, it had actually come down during the day as the market had rallied. And so, but that's a little bit of a warning sign that happened yesterday that to pay attention to, and you put that in context with everything else that you're looking at, reaching these overbought conditions, and it's just another one of those clues that's telling you that maybe we're getting pretty close here. So we'll see what happens this week. All right, that wraps up the market update. Let's look at just a couple of individual stocks here, and then we'll get into the training. On the retail sector here, under the hold section, I still like, by the way, there's GameStop right there. I would not, even though it has a 99 strength rank. It has a 99 strength rank because it went from a $30 stock to $500 in a week. So I would cross that off the list. I would not get involved with GameStop unless you're treating the market like Vegas and you think it's going to go back up to $500 again. But the chances of that are pretty low that it's going to move back up to that area again. But I like Lumber Liquidator down here. It has a 92 strength rank. But I pointed this out before. Let me switch this to signals here. We looked at this last week as well. I like the fact that it's come off a deeper correction right here. This looks like a bullish ABC pattern on the pullback here. And it has moved up a little bit higher from when I pointed this out last week. Again, a little bit closer to getting to that buy signal. Still has a little ways to go. It's kind of the halfway point of that hold range. But because of that deeper correction, it's likely to break out and it probably has some room to run. In fact, if it does break out above this high right here, and again, for those that are new, I point this out all the time, but when you have a correction like this, a possible correction, we don't know for sure if that's a correction. We could be in a downtrend. This thing could roll over and drop and go lower. But if that is a bullish correction there and it does break out, the key is if it needs to kind of break out first and break out from here. So we're assuming this is going to rally back up and break out. But you can take the depth of that correction from the bottom of that correction to the top and project that distance from the breakout area. So project that distance upward. And that gives you kind of a minimum target of where you expect that stock to go once it breaks out. Now, it doesn't always get there, and I always point this out. It's a rule of thumb, but a rule of thumb also means that it does it a lot. It does it enough times where you can expect it to. But anything in the market, you can't believe in absolutes in the market. Nothing is absolute in the market, but it helps because particularly those of you that just don't know when to get out or how long to hold something. It gives you at least an area of expectation of where you expect it to go. And it's a lot easier to stay in your trade and get those bigger returns when you can see a target area of where you expect it to go and have confidence that, it should get there, because most of the time it'll get to those areas there. You can see examples of this all the time within trends. Here I can just see this right here, just on this little uptrend right here. you had a pullback right here. We could take the distance of that pullback, project it from the breakout area. And you can see this did get to that area. It went a little bit further before it pulled back right there, but it made that distance. You could take this pullback right here. When it just started out. Take that distance, project it from the breakout area, and that could be maybe why it reversed right there, was based on that measurement. So, and you can do it on the way down too. You could take, here's the correction right here on the way down. Here's the sell-off. You take that distance, project it downward. Not much of a surprise. It stopped right there and started rallying. Now, again, I could show you probably about 10 or 15 cases where it didn't make that move, so I don't want to assume that it's, because you can look at this and say, boy, that's incredible. It was almost exactly that distance, and that's where it stopped. And I can tell you that, there's cases where it goes even further. There's cases where it comes up a little bit shorter. But again, it just gives you a target area to focus on. And, if you're expecting it to get up to, this area right here, I would see no reason to get out of that yet. You did get a bearish reversal candle right here, so you can get, as you get close to that area, you can start looking for bearish reversal candles. If you had the training on how to read candlestick formations, we did that training several weeks ago. Actually, it's been a couple months ago, I think now. But you can you can combine the two, where you're getting to that area where you expect it to go, and now you're seeing a bearish reversal. You can go ahead and get out or tighten up a stop or make a trade decision based off of that observation and that expectation. All right. Let's go to computer and technology. And I liked this OIIM, O2 Micro. Had a 95 strength rank. That's another thing too, that we probably need a little bit of a pullback, as we've got, it's hard to find stocks in that 98 strength rank. And that's because most of them have gone to buy signals, and so they're in the buy range. We saw that when we looked at the buy-sell ratios, how wide that was. There's a lot of stocks that are in that buy range. We get a little bit of a pullback. A lot of those pull back into the holds. And usually when they pull back into the holds from a buy, you get a pattern that's showing up like on this one, where you're getting kind of that correction, that pullback. You still have a nice strong uptrend. So when this thing started to pull back, it went to hold, even went to sell for a little bit, and went back to buy, and then the trend was off and running again. So now this could drop a little bit further. If this is a C leg, wave A, wave B, wave C, it could drop down here a little bit further. But that's why we're waiting for it to go back to the buy signal as confirmation. But just want to point out that looks like it's starting to correct again, kind of similar to what it did back here. So keep an eye on that one. And then lastly, under construction, the holds right here, I like the one at the top, 97 strength rank, ENG. And kind of the same thing, you're seeing it consolidate a little bit sideways right here. And I know many of you are sick of me quoting this, but you get it. If you get it in your head and you see it all the time on the charts, it's one of the strongest signals to know what direction a stock should be moving in. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moves sideways. That's where it's likely to go, not absolute, but likely to go. Once it's done moving sideways, it's likely to continue in that direction. So down here, when you saw it moving sideways, it was moving up before it moved sideways. That's where it was likely to go after it's done moving sideways. Doesn't always work, but it works enough times where you're going to be right a lot more often than you're wrong. But that's why I like that one. It looks like it's consolidating, and once it's done, it should make another run. and you could wait for it to go back to that buy signal as a little bit of confirmation that maybe it's starting to run again. All right, that wraps up the market update portion. Let's get into the training. And what we're going to talk about today, and what we've been talking about over the last few sessions, is we've been talking about Elliott wave analysis. Those of you that are kind of new, you can go back and review those recordings if you want to get, well, you probably would want to do that because some of this may not make a lot of sense to you until you get a little bit more of the background. But basically, the market, Elliott wave analysis is based on the fact that markets move in cycles or waves. We call them waves. And within these cycles, there are certain characteristics, certain psychological things that are going on that can help you understand better where you're at within a trend. And in other words, there are common, remember, these characteristics are based off of human nature. And so that's why they always work, and they always will, is because we're as humans, we're going to keep doing the same things over and over, make the same mistakes, make the same decisions. We're seeing it happen right now. I mean, I am amazed at how similar this era right now is to the internet bubble of 2000. Any of you that traded during that period of time probably are seeing a lot of similarities. It's not exact. There are different reasons why the market is getting extended, and your different reasons why your hairstylist is giving you stock picks. I kind of crack up. I've been doing this a long time, and I've poured my soul into trading and learning everything I can about it. I still have a lot to learn, I would say. That's a great thing about trading, is that you can never know everything about everything. But I could always tell when I'm getting near a market top, when I have my some of my friends and relatives that have nothing to do with trading starting to give me trading advice. You ought to buy this. You really ought to look into buying this, and that kind of stuff. But there are those characteristics that start to show up in these different levels. In other words, there are characteristics of a market bottom. When you're at a bottom and you're going to start to go back up, there's characteristics of a wave 1, wave 2, wave 3, wave 4. They all have different characteristics. And characteristics when you get to a top, how can you recognize when you're at a top? And as we go through these, you'll probably start to kind of laugh a little bit as we talk about topping type of characteristics, because we're seeing them all over the place right now. But these are those basic characteristics. And we're going to start with a bottom. What do things feel like in a market bottom? Let me go back to the other slide here. Remember, we talked about this before, that when we talked about cycles, we said that when you get into these markets, when you get into bear markets or big sell-offs, usually what you're doing is you're in a larger correction. The expectation is that markets are always going upward or forward, but obviously, there are periods. You had the Great Depression where the market was down quite a bit. You've had the Great Recession a few years ago in 2008 where we dropped dramatically. Well, these are all considered pullbacks within the larger trend. So what we're anticipating right here, or what we're talking about right here, is we're getting through a big correction. And what does it feel like? How can you recognize when you're at the bottom and you're getting ready to start a new uptrend? By the way, wave A, wave B, wave C also have characteristics as well. We'll talk about. They're not on the slide here, but I'll talk about those characteristics as well. Now, we also need to be aware that there are different wave degrees, and so these characteristics show up at different levels. In other words, this is a bottom right here from this correction, but because it's a smaller correction, those characteristics aren't going to be as big as these ones right here. Here's a smaller bottom of that correction right here. those characteristics are going to be much smaller than this one. So, and I'll try to point some of that out as we're going through the list here. All right, so we're starting with a bottom. What does a major bottom feel like? Well, when we're talking a major bottom, meaning that, you know, those big corrections, Great Depression type moves, and obviously we're not going to deal with those very often. But how do you know when you're in a Great Depression type situation? How do you know when you're close to that being done? Well, on a large degree, there's a question of existence, survival, depression, war. There's a feeling of, is this ever going to end? There's a feeling of hopelessness. Now, you don't get from exuberance to hopelessness overnight, right? And what's happening, let me go back a slide here to that chart, is as you're dropping right here. So when you drop right here and then you start to move back up, you assume that this is just a pullback within the uptrend, right? And this is going to take off again. You're still really bullish. You're not worried at all. In fact, this is a great buying opportunity. And so you buy a bunch of stocks and then you lose money. And you say, okay, well, it still looks like just a correction. Maybe this is an ABC pattern right here, and we're going to go right back up again. You buy a bunch right here, it goes up a little bit, and then it drops, and you lose money. And so each of these phases, you have that hope that it's going to go back up, and then you lose money. You hope it's going to go back up and lose money, and so your mood starts to shift from hope to, when you get down to the bottom here, you're like, you're out of money, you're broke, maybe you're in debt now, and when you're really at the bottom, you've just lost all that hope. In fact, you're wondering how many more of these are we going to see? Anytime the market rallies, it's like, here we go again. We're just going to go lower. You get to the point where you're just like, you think, you know, how much further is this going to drop? You know, you talk about survival, you know, and all these are really, you can see these, well, you can see them more clearly in studying the history of the Great Depression, you know. Even the Great Recession created some of these characteristics, and maybe some of these. Another thing to keep in mind too is that individually different people have different experiences as well. There were people that lost everything in the Great Recession and really were in a sense of hopelessness and survival. And are they ever going to have a life again? There were others that didn't hurt them that bad at all. So yes, it hurt a little bit, but it wasn't that bad. But that's what we're talking collectively. And I think collectively, with the Great Recession, collectively, we didn't quite get to the level of question of existence survival. And that's why the market rebounded, I think, so quickly from those conditions, is because there wasn't enough pain there where people didn't trust the markets, didn't trust the banks. Remember, banks were failing like crazy back in the Great Depression, and people were stuffing money in their beds, because in the mattresses, because they didn't trust the banks. Well, we didn't quite get to that level with the Great Recession. So, but those are some of the feelings, and so in other words, when you're feeling the pain of the situation, that's usually when you're at the bottom or near the bottom. Now, important thing to point out is that none of these characteristics are very general, so none of these are going to tell you exactly when the market is going to turn. In fact, it could remain in these conditions for a few weeks or a few months possibly before you actually see the results. But like we were talking about in the market update, when you get into these conditions, you start to look for signals of reversals, or, so I would start to, when everyone's really scared and wondering how much further things are going to drop, I start looking for bullish reversal signs. Now, with using these techniques, I was able to predict the exact day of the bottom of the 2008 financial collapse. Actually, it bottomed in March of 2009. Now, I don't want to paint myself as a psychic or anything, because it was pretty simple. Everyone was talking about how much further the markets were going to drop. When was this going to end? Things were getting pretty dire. And there was a Fed meeting that was going to be happening, an emergency meeting that's going to be happening that week. And I believe they were going to restrict short selling to keep the markets from dropping down. And then they were going to, I think it was something to do with the mark-to-market accounting rule with the banks. They were going to suspend that for a little bit because that was hurting the banks. But anyway, there was a date of when this meeting was going to take place, and we were reaching just these extreme conditions. I was recognizing these extreme conditions, and I was teaching classes at that time. I said, I just had this feeling like that meeting is going to cause the market to rally, and that could be a sign of the bottom. And sure enough, it ended up being the exact date of the bottom there. But again, what made that a little bit easier was there was an actual meeting along with these conditions, and the meeting was signaling that it could spark a little bit of a market rally. Now, believe me, it wasn't until hindsight, I'm looking back, that I got that exact day, and I didn't trust a lot of the rally as it started to rally back up. I was still pretty cautious because I'm human. I'm part of the market crowd, so to speak. And so, but it was recognizing those conditions that allowed me to kind of signal, hey, we're pretty close to a bottom here. We're starting to see, there's a Wall Street saying, many of you have heard of this before, you want to buy when there's blood on the street. I think it's J.P. Morgan that made that quote, or it's J.P. Morgan's father or something like that made that quote. But that's kind of the idea here, is that when everyone else is panicking, that's when you want to buy. And believe me, it's an easy saying to quote. It's very difficult to do, but it's easier to do when you can recognize some of these characteristics. On an intermediate degree, you're dealing with recession, more of a panic, or limited wars. I think that the Great Recession, the financial collapse of 2008 was more of an intermediate bottom. I think the Great Depression was more of that large bottom, based on those characteristics there. I remember back. Oh, where was it? It was, the market had a correction. I think it might have been. I want to say, I think it was after the internet bubble. We had a little bit of the market pulled back. Actually, it was mostly the NASDAQ that pulled back. And there were some Elliott wave, or people studying Elliott wave, that were saying that was a major bottom. And I said, no, it doesn't meet the characteristics of a major correction. In fact, there was an argument going on at the time between Republicans and Democrats as to whether or not we even had a recession. Some were saying we got close, we didn't quite reach a recession. Others were saying, oh, we barely did go into recession territory. And so when you're arguing whether there was even a recession, I think you're definitely going to cross off the large degree major bottom taking place at that point. On a minor degree, it's just maybe bad news. So maybe a individual stock, maybe they have an earning announcement, they miss their numbers. It's some bad news. The stock drops the next day and kind of bottoms out there. It already maybe been dropping for a little bit, and had the bad news come out and it dropped even further, and that can sometimes mark a bottom. That's why sometimes you'll see some of these companies that report earnings will have a disappointing earnings report. It'll gap down, and then it'll start rallying all the way back up again. That bad news just kind of created that short-term bottom. Okay. The point here, though, this is what allows you to be a little bit more of a contrarian. When you start hearing bad news start coming out about on a stock, that's why you want to look at the chart, because it doesn't always mean that that stock is going to go lower. Same with the good news. It doesn't always mean the stock is going to go higher. You want to know where that stock is in its cycle. I mean, if you go back, go back to the slide here. Hold on. You know, if you have bad news that comes out and you think you're in a wave 4 of the uptrend, then you're not going to be too worried about that bad news because of where that bad news is coming out. If you have bad news that's coming out, you know, up here somewhere, you know, that could be signaling a bigger correction that starts, or bad news that comes out down when the stock's already been dropping in a big way. You probably are assuming then that thing's about ready to be done with the drop and could start to move back up. And one other thing to point out, I mentioned earlier too, is that, you know, we all want to get in at the beginning of a trend. How many of you looked at like Tesla or something and said, man, why, or Amazon or something, like, why couldn't I have bought that thing when it was $10, you know? I mean, we all do it, right? We've all done it at some point in time. We've looked at a stock and, man, I would have loved to get in down here. Well, the problem is that when Tesla was down there, it didn't feel like Tesla does up here. And so how do you get in down here? You've got to be willing to get in when nobody likes a stock, when everybody is telling you. In fact, I use this as a guideline sometimes. When I'm looking at a stock that's gone through a major correction and I want to get in because I think it's going to turn around and have a good run, I'd like to throw it out there to some trading friends of mine. Hey, what do you think of this stock? Oh, and usually if they come back and say, oh, forget that one, that was a terrible stock. And you look at the chart, if you looked at the fundamentals of that thing, well, that's exactly what you would get at a bottom. The fundamentals wouldn't look good. The chart maybe in the near term wouldn't look good because it's probably been trending down on its correction right there. But that's how you get in at the beginning of a move, is you got to be willing to go in when nobody likes it, when it, you know, people are wondering how much further it's going to drop, right? Now, I just don't buy it based on the characteristics. I'd want it to show me some signs that it's turning around and starting to move up. But let's say it started to move up a little bit, and you've got those bottoming characteristics. A lot of times that makes me feel like I'm on the right track. Now, notice how you're going against human nature. Human nature is to say there's nothing good about this thing right now. Why would you want to buy it right here? And so that's why it's good to combine these characteristics with the charts you're looking at. It can help you get into things ahead of time. Now, let's go to the wave 1 characteristics. Wave 1 is a rebound from undervalued levels, or a recognition of survival. Another way to put it is there can be a kind of a here we go again type of feeling with it. And it's understandable. That stock's been dropping. You get that wave 1 moving up, and what do you feel? Well, you feel like, here we go again, right? Here we're going to rally, and it's going to roll over, and it's going to go lower, right? It is rallying, but I've been burned on that. Every time it rallies, I buy in, it drops lower. So it's a kind of a recognition of survival. It's starting to move up, but it still doesn't feel overly bullish yet. Now, what's interesting about wave 2 is a test of the lows, or it's kind of the first pullback after the drop. You know, you've had this big drop. Here you have your recognition of survival. This market starts to move lower, and again, a lot of times the feeling is, here it goes again. It's gonna go lower. What's interesting at the bottom of wave 2 is that sometimes the conditions at the bottom of wave 2 can be equal to or worse than they were at the bottom. You know, some of the worst conditions of the Great Depression were felt when the market had already started to turn around, started to rally. There's a little bit of that delay. In an individual stock, it could mean that they report a loss of $1 per share, and the stock rallies a little bit, then it starts to drop, pull back again, and they report a loss of $2 a share or something like that. Their loss is worse than it was down here. The difference, though, is that it does not go to a new low. That worse news does not carry it to a new low, and so that's, you know, when you're paying attention to this on a chart or a company or the market in general, is do you see really bad news come out, but it doesn't go to a lower low? It doesn't go to a new low. That's usually a sign, a good sign that a bottom is in place. In fact, usually that wave two is where I don't like to try to pick a bottom on stocks or on markets. I love looking for where that wave two is. You know, where you get this bad news that comes out, but it doesn't go to a lower low. You start to get a feel like the trend is turning. Now another thing is being able to recognize the impulsive and corrective moves I've talked about in those previous trainings. We're going to go a little overtime today. Hopefully I can speed this up a little bit. In fact, maybe what I'll do is I'll break it down. I'll do a few more here, and then we'll finish the rest on Thursday, because I don't want to just skim over this stuff because it's so important. We'll end at wave 3 here for today, and then we'll do the rest on Thursday. But remember I told you the stair step. I said, when I was talking about the stair step, I said stocks will tend to alternate between impulsive and corrective moves. Impulsive is when it's moving sharply in the direction. Corrective is more choppy, more sideways. And we see that here. This is impulsive. This is corrective. This is impulsive. This is corrective. When you get a reversal, usually one of the signals of a trend reversal, it's not always this way. So we've seen plenty of cases where you get impulsive moves back to back. But a lot of times you'll get, when a trend reverses, you'll get impulsive moves in the opposite direction. This final wave 5 is an impulsive move up. This wave A is an impulsive move down. And then what happens? You start to alternate again. You get impulsive, corrective, impulsive, and then when you're done with the downtrend, you'll usually get impulsive down, impulsive up. That impulsive up is usually wave 1. When wave 2 pulls back, it should be more choppy, more sideways. If you're getting an impulsive move down, you're probably not done with the downtrend. It could end up dropping lower. So what I look for is not only that rebound from survival wave 1, but you get wave 2. Again, at the bottom of wave 2, conditions can often be worse than they were at the bottom of the main bottom there. They can be sometimes worse, not always, and that's the thing. These are very kind of general statements I'm making, but if the condition, the company reported worse earnings, worse conditions, but it didn't go to a new low. Not only did it not go to a new low, but on this pullback, it was more choppy, more sideways. It looked like a corrective move. There's a good chance that thing is taking off. Now, I don't want to say that I use this in the Zoom trade. I talked about last week. Hopefully, you made some money on that one. But remember, I was pointing out on Zoom that this looked like a large. We had this large uptrend right here. This looked like wave A, wave B, wave C. And this looked like it was a little impulsive move up. It looked like a wave 1. And this pulled back right here, but looked more choppy. This looked like a wave 2. So in the context of everything, this looked like we were just starting a move up. And it wouldn't be too late, because if this is going into wave 3 tends to be the longest wave, the strongest wave. This thing could just be getting started. But that's what I was recognizing. And you combine that with, now I wasn't going off of any characteristics, because I really wasn't aware of any news on Zoom. I was just going off of just the chart. But I would assume there was probably a negative feeling of Zoom down here. In fact, I will say that I had heard some things that people were thinking that the stay-at-home trade was over, vaccinations going up, that Zoom may not be as popular going forward or whatever. That was starting to happen down here in the end of January, end of December, beginning of January. That could be, maybe that was the bottom of Zoom, that negative news. We'll see. We'll see how that plays out. It could be, by the way, this Elliott wave is always perfect in hindsight. You know, Zoom could be all the way down here next week, and you could say it was great, Jerry, some great prediction there. That's why you still have to have trade management, money management, stop losses, and things like that, because none of this stuff is going to always play out perfectly. All right. All right. Let's go back here. All right. Then you go into wave three. Wave three is the most powerful wave. Its characteristics are strength, breadth, the best fundamentals, increasing real prosperity. By the end, the underlying trend is considered up. The wave often subdivides. Remember, we talked about wave extensions last week. We were going over those wave rules, and is never the shortest wave. Wave three is usually when people start to be drawn into a stock. You know, it again, if we go back to that chart, you know, remember wave one, you don't really trust that the bottom is in. Wave two, you're still seeing worse conditions are still bad. In wave three, though, is when not only do you go to a higher high, now you've had that wave two higher low, but now the trend is starting to look like it's up. This is when you start to see companies blowing out their earnings report. You know, they said they were going to make $2 a share. They made $4. Now, I would add something to this, though, too. When you're in wave three, not only is it usually the strongest wave, and what really drives it as the strongest wave is there's still doubters in wave three. I think that's important to point out. There's still people that are saying, yeah, it's had a good run, but remember that decline it had, you know, this is probably not going to last that much longer. And you might have heard the term that stocks climb a wall of worry. When you're expecting the markets to go higher and you want the markets to go higher, maybe you have a lot of positions, you like to have a little bit of worry in the market. You like to have people saying, I don't know if it's going to continue. Here's my reasons why it could be done, and you know, this, we got to worry about this and that and this. You like to see a lot of that still in the market, because it means that there's still buyers that can come in. The doubters can still come in and push the market higher, and they often do, because as the market keeps going higher, pretty soon they're like, oh, well, forget these reasons, I'm missing out. And that's what kind of fuels that. Now, usually wave three tends to be the most impulsive wave. And so whenever I pull the chart, whenever you see the biggest move, the most dramatic move on a stock, typically that's wave. In fact, I always assume that's a wave three until proven otherwise, because usually that's a wave three. It could also be a wave five, but usually the strongest move you see that stock make, the biggest move you see that stock make, is almost always wave three. And so I just assume it is, and that usually jumps out on a chart. You pull up a chart, you can see the biggest, and that could be to the downside as well. Wave three down. You know, remember, you have these 5 waves down, these same characteristics are to the downside. Wave three down will be usually the strongest move down. Okay. All right, I'm going to cut that off there. We're going to do wave 4, wave 5, and then the ABC on Thursday, because I'd be here probably another half hour trying to go over those ones. So we'll do that on Thursday. All right. Thanks, everyone. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.